My name is Craig Coco, and I've been day trading full time for the past 8 years. In this video, I'm going to walk you through the 10 harsh truths of trading that I've learned the hard way, losing real money, rebuilding, sitting in front of the charts for years, figuring out what actually works to become consistently profitable. And this is not a feel-good motivational list. This is going to be a practical SOP made from trading with real money and real consequences. Some of what I'm going to share with you is probably going to be somewhat uncomfortable, and it might clash with what you want to believe about trading. But I promise you, this is what I wish I had from the start of my journey to get to where I am now, because quite frankly, it would have saved me a lot of time, effort, money, and energy that I didn't need to spend. So regardless of if you're brand new or you've been trading for a long time and you aren't quite where you know you should be, if you stick with me until the end of this video, I promise you, you're going to look at trading completely differently and have things to immediately apply to hopefully improve your trading. Okay, so let's get into it. So harsh truth number one, and one of the most important first things to do that a lot of people quite frankly glaze over, is to identify and accept your mental flaws and learn how to rewire those. When you're trading, it's effectively like a mirror showing you all of your own internal mental flaws and things that are going to hold you back throughout your entire career. Things that would typically make you successful in other ventures of life will actually be the things to lead to your demise in trading, which is oftentimes why a lot of people who are very smart and very successful suck at trading. So we have to be able to look inward and identify our predispositions towards things like fear, risk, uncertainty, how we feel about reward, because those beliefs are going to sneak into our trading habits whether we acknowledge it or not. And this is oftentimes this final piece that prevents people from actually accelerating to the next level. Keep this in mind. This is going to be more important a little bit towards the end. So make sure that you're thinking about that as we're getting through the rest of the video. But the reason that we need to identify these things can be sort of explained by this example. Okay, most people as children are taught that snakes are dangerous. So even if you're handed a completely harmless snake, you're still going to feel fear. So logic is telling you that there's no risk, but the fear is telling you that there is risk, even though you know there is no imminent danger. And trading is going to mirror ideologies like this perfectly. You know and trust your edge, but these subconscious beliefs are going to sneak their way into your trading and alter your behavior if you're not making a very deliberate effort to identify each of these pain points and address them in your trading. And I'll explain how we can do that later, like I said. So the goal is to effectively be able to rewire your brain to not think like a normal person in order to be the top 5 to 10% of people who actually make money in the market. Kind of a weird concept, but that is one of the most overlooked keys as well. Harsh truth number two, keeping things simple and that less is more. Trading is already a complicated thing, and especially when you're first getting into trading, it feels like there's a million different little pieces that need to come together in order for you to be a successful trader. Now, yes, that is true when you get to a certain level, and it can be the truth. However, trading, if you boil it down to its simple basics, actually isn't all that complicated, and all you're looking to do is find different things to add to a simple mathematical formula in order to be profitable over time. But with trading in general, the core should always be hyper simple, because let's face it, everybody is trading basically the same information in the market. It comes mostly down to who can actually execute on their edge repeatedly without letting their emotions take control, making mistakes, and allowing you to switch what you're going to do based on how you feel in that instant. All we're effectively doing is finding variables to input into our system, and the lower amount of variables possible while still getting a desired result is going to lead to a lot less emotional mistakes and a lot less decision making on the spot that can sort of veer you off course with your pre-designed plan. And the only time we should be adding things into our process is when we have a core that works and we have statistical reason to believe that that is going to be an added benefit to our bottom line over the long term. Keeping it simple, especially in the beginning, is critical, but every profitable trader that I know and hyper wealthy person has a stupid simple way of trading that requires the least amount of on-the-spot decision making. Which brings us to harsh truth number three, which is focus on trading one asset, one strategy on one time frame. Because mastery requires narrowing your focus down onto one thing and doing so many repetitions that it's basically second nature to you, and you're able to execute when the pressure's on, when you should otherwise be emotional. Think about a professional basketball player. When they're in a game time situation where everybody is counting on them and there's a ton of money on the line, if you listen to any professional athlete talk, all they do is say, yes, I'm nervous. Yes, I feel all these emotions, but I trust my physical ability and my training so much that even if my brain is worried about the circumstances or nervous, I can compartmentalize that and just fall back on the repetitions in the training to be able to execute the way they know they can. The same is going to be true with your trading. You need to put in so many repetitions that in that same sort of potential fear environment, you're just executing seamlessly because you've done so many reps and you completely trust yourself. If you're trying to look for 5 different strategies on multiple different time frames with multiple different variables, you're now taking trading from being a filtered down, repetition-based process to basically just doing whatever your brain comes up with at time, hoping that you have luck or that you're going to go on a hot streak. And that is not trading, that is gambling. That doesn't mean that you can't learn other strategies. I primarily trade 2 different strategies, but I'm never blending these strategies into one trading session, keeping them very separated based off of the conditions that the market is going to give me. Once you master something and you have your formula down, yes, you can obviously venture into different time frames, different markets, and be effective, but being able to compartmentalize those and make sure that each one is working successfully is a key component to actually being able to make money in trading. Okay, truth number 4 is the necessity to be measuring your results, because this is where actual improvement is going to come. Whether people want to believe this or not, trading is a business. Businesses are always going to operate off of metrics. Why do you think that companies like Apple or Google have full dedicated teams to refining data down and making data-driven decisions? The truth is it because things that are easily observable aren't always telling you the truth of what you need to do. That's leaning into observation and emotional decision making, whereas a lot of the really important information isn't going to be surface level available just off of observation, is actually going to be buried in the form of data. And it's our responsibility as traders to be able to have a starting point to observe what we're actually doing to make corrective changes and figure out whether or not what we're doing is worth doing, if it's working, if it's not working. Because a lot of times trading is an emotional game. It's very easy to fall into this trap of thinking, I know my strategy works, it's not working right now, but if I just do X, Y, and Z, or if I had a little bit of different luck at this point, things would be different. And it's very easy to start taking it very personally when something is not working. If you have a model that you have designed and your only goal is executing that model as closely as possible, this is where you're actually going to start breaking through. And I'm going to get more into this in just a second, but really just to drive this point home, what we're doing with trading is having an observation, isolating variables, and then testing out different variables in different conditions, combinations, and in different market data to see if we can have positive result at the end. And that is literally the definition of profitable trade. And without this measurement, you're literally guessing, hoping, gambling. You can't identify what your actual flaws are, and you live in this fairy tale land where you're never actually making progress, and you're just trying to convince yourself that if I just did one thing differently, I'm going to be able to be successful. Don't fall into that pit. I did it for years, and I know a lot of people who still do it, and I promise you, you don't want to be in that situation. So you have to measure your data in forms of journals, trade trackers, something to be able to look at what actually is going on versus what you think is going on. Which brings me to harsh truth number 5, which is that expectancy is everything. Most people don't really understand what expectancy is, but this is what institutions are using and what professional traders actually look at to determine whether their edge is working over time and whether or not changes are positive or negatively impacting the model that they're trading. Okay, because positive expectancy is literally the definition of profitability. Everybody can calculate their own expectancy as long as you're actually journaling your trades, keeping your sizing uniform, which I'll get to in just a second. But basically, we want to find out our winning percentage. Okay, so say that 60% times the average size of our win in terms of R. So if we're risking 1 R on a trade, so say we're taking a position where we're entering here, and this is our 1 unit of risk, our reward would be 3 times that, so 3R. Say over the course of 100 trades, our average when we are winning is something like 3.1 R. That's our average win. And we're taking this and subtracting it by our losing rate, which subsequently is 40%, multiplied by the average size of our loss, which should be factored in as -1. If we have 1 unit of risk and you're losing 1 R, then that should be your downside. Okay, so multiplied by 1. So we have 0.6 times 3.1. Okay, so now let's calculate this out. And I'm going to show you, this is really cool data, and you can do this for yourself and figure out where your trading's at. This is what you should be focusing on aside from all the other stuff. Expectancy is literally the number that you need to focus on. So if we have 60%, 0.6 times 3.1, that gives us 1.86. We take 0.4, obviously times 1 is going to be 0.4. So we have 1.86 minus 0.4, which is going to give me 1.46 as an expectancy. Now, say I'm risking $100 on a trade. That means that every time I risk $100 on a trade, whether or not I win or lose that individual trade, with these metrics, I know my expected profit on the trade is $146, whether or not I win or lose. This is expectancy. Now, if this is a positive value, you have a positive expectancy in a profitable model. But what you're doing is now basically collecting stuff in the market, feeding it into this data, and figuring out if you have a positive or negative number and by how much, and And then anything that you're adding, indicator or confluence, all you're doing is adding it to all of the data that you've collected and figuring out whether or not that pushes the needle forward for your expectancy or further away from your expectancy. And now you're only ever adding things that are statistically proven, which then allows you to focus on only execution that is going to impact your expectancy. And it basically transforms the way that you look at trading rather than looking at it, I got to make a certain amount of money per trade. You're kind of removing all of that out of it and looking at it how algorithms look at it and how institutions look at trading, but with your human edge. And this sort of bleeds into a secondary point where the importance of making sure that your position sizing is always uniform, which kind of falls back into being able to measure things. But in order for any of this to work, you have to be position sizing effectively. Okay, so anytime we're entering the market, say we're entering right here, you can literally just use the position size tool on a charting software like TradingView or whatever, and it will tell you the units if you input it. But just so that you understand how this works, effectively, if we're entering here, looking for price to go here, which is going to be a win before a loss here, we can take that dollar amount risk, which is 100, take our entry price, which say is 100 as well. So 100 minus our stop price, which say this is 90. So this level right here, which would obviously give us 10. So then we're going to take 100 divided by 10, which is obviously going to give us 10. So if we're entering here with 10 units and we go down by $10 per unit to our stop loss, we're now subsequently risking exactly $100. And now this is easy with simple numbers, but if you get into decimals and fractions and large amounts in really small positions where you have to buy, 2,160 units of something at 153.76, now you need to understand how to do this math and make sure that you're risking exactly what you're calculating into your expectancy in order to make sure that you're profitable. So super important point. On the back of this, one thing to focus on is how good a trade is has nothing to do with whether or not you make money or lose money on that trade. What makes a good trade is how closely did you adhere to your model that has positive expectancy over time, whether that means that you made a full loss, you broke even, you made a small amount of profit, or you let it run and had a massive trade. All of that is completely separate as to whether or not that was a good or bad trade. So gearing everything around this simple framework, looking at expectancy and looking at position sizing, now kind of liberates your mind and just says like, this is the only thing that I need to focus on, and the rest is just noise that I can choose to learn and add into my process. But start simple, only add when it's necessary, and that's how you're going to get ahead. I promise you, it doesn't have to be overcomplicated. Okay, so harsh truth number 6, back test first. A lot of people are very anxious to get into the market and start deploying real capital. I hear it all the time when people ask me about trading. They're like, just started trading, I put a little bit of money into an account, been playing around with it, but I'm losing money. Trading is the only business model where you can literally dry run it on data and know exactly what is going to happen if you execute it into the future without having to put real risk on the table. Okay, most people are going to be trading on TradingView, which you can see has this bar replay function here, in which case you can literally click on select bar, bring this back to a period where you don't remember what happened, and literally play this forward with your rules to see how you would act in real time and what your expectancy is going to be. So you can literally do this and test over months of roughly how you would perform before ever entering into wasting time either paper trading or real trading the markets with a system that turns out it doesn't even work. You still have to go through those reps because it is going to be diminishing from doing bar replay to paper to real trading. But the goal is to be able to have such a high expectancy on your model. Then when you bar replay, it drops a little bit, but still high. Paper trading in real time is still positive, but a little bit lower. And then in the real markets with slippage, transaction fees, mistakes, your expectancy is still positive. That's what you're shooting for. Now, more time backtesting isn't always good. It's very easy to be profitable in a bar replay setting and then not profitable when it comes down to really trading it in real time. And that's why at the beginning of this video, I talked to you about these emotional predispositions that you need to be aware of. Whether you're anxious, impatient, where you tend to second guess yourself, being aware of all these things is going to kind of lead into whether or not you're able to execute this in real time. But the goal with this is to be able to measure until you have what's called statistical significance, meaning that you know your edge or your strategy is actually worth deploying into the real markets, so that then you can get out of the simulated environment whenever the data is telling you, rather than because you're anxious to do it or because you want to make money or because you want to start trading. Then you have real conviction. And additionally, if you're just starting out with trading or you sort of want a fresh start, you could literally set up 2 months of time to go from bar replay to paper trading while stockpiling up capital to be able to carefully deploy when it comes down to trading the real markets, right? Everybody's risk tolerance is going to be different. Everybody should start with what they're comfortable with, of course, but there's no need to jump into the markets right away. Back testing first is critical. Which brings me to harsh truth number 7. 7. And this is a pretty simple one, but probably one of the most important because it's something that I definitely struggled with. That is probably one of my number one focuses and one of the reasons why about 2 years ago I set up a daily loss limit to just basically say I'm done trading on this day if this happens. So let's think of it like this way. If we're comparing something like soccer to building a house of cards. In soccer, you can have the most screwed up play where everything goes wrong and everyone's making mistakes simultaneously and the whole team could just fall down or lay down. The other team would dribble through everyone, score a goal, and that's -1 point against you or 1 point for the other team. The worst case scenario is you're getting 1 goal scored against you no matter how much you blow up or make a mistake. Trading is very, very much not like that. If you have a lapse in judgment that can happen very quickly, it's extremely easy to have a ton of downside when it's really difficult to have upside. Profiting in trading is not an easy thing to do. It's a grind. You have to constantly be disciplined. So in terms of building a house of cards, if you mess up one small thing, all of the work that you've built up over a significant amount of time can be erased instantaneously, which is why you have to set safeguards for your own behavior. So anytime I'm trading, it's really easy to watch a trade that would have worked out had I have taken one more trade and try to revenge trade, make your money back on the day. These are very common things that your brain is going to try to trick you into doing. What I do is if I take 3 losses, so -3R in one session, I am walking away and I am hanging the jersey up for the day and I'm going to reapproach it on the next day. Because I'll tell you from experience, some of the biggest detriments to my account and to my trading in general have come from days where I have an off day. Sometimes it's just going to happen. Sometimes your edge is not going to work with the way the market is currently moving in that circumstance. But you didn't test your strategy over one day. You tested it over 3 months, 6 months worth of data. If you're putting a disproportionate amount of trades on one session when everything is going against you, trying to revenge trade, trying to take double the size to earn it all back, this is where your house of cards are going to fall completely down and you're going to waste all of that work that you've just spent a lot of time, effort, energy, and mental capital to building, which is a very hard thing to come back from when you have a lapse of judgment that you know isn't part of your mathematical strategy. So putting that daily loss limit on yourself to be able to say, you know what, I walk away no matter what. I respect myself. I respect the effort that I put into getting to this point is a key element for me that I always like to follow. Which brings me to harsh truth number 8, which is you can go broke taking profits. So you need to make sure that you're not taking profits too early and that you're not holding losses that you should have cut when your stop loss told you. I've always heard this saying, you'll never go broke taking profit. If you have profit on the table, take it. When you're playing very desperately, especially if you're coming off, say, a losing streak or your account's in drawdown, it's very tempting, especially if you watch a trade go all the way, say you're up 5 or 6 risk reward, and then the trade comes down maybe to a small win or even a break even. The next time you're in that situation and you see any movement in the opposite direction, now it's triggering that fear response where you're like, I've spent all day last week in this trade, letting it play out, and it came all the way back down to my entry. I should take profit off now. Only to have that trade then continue moving up and maybe go up to 12, 15, 20 more risk factors, in which case your expectancy in your data is literally requiring you to let those winners run and make sure that you're not allowing your losses to also get out of control. Because if you start doing that, now you start modifying all of your data and you can basically throw all the work out the window that you've done and you're starting from scratch and you don't even know whether or not you're going to be profitable over time, in which case you're sitting in front of the computer, literally wasting your time. I can't emphasize that enough. This is one of my biggest problems, is taking trades off the table too soon. Okay, you have to follow your rules in your data, and it's always better to allow your trade to run slightly for the upside and have a systematized way to walk your stop loss, taking profits along the way to allow your winners to run and keep your losses contained. Harsh truth number 9. In order to be successful in trading, you have to not think about the money at all and let the money be a byproduct of you focusing on your process. That can seem somewhat abstract because everybody has goals for themselves, which is going to require daily goals, and eventually you do have to gear that somewhat around money. However, if you're trying to chase a daily dollar amount, this is almost always going to lead you into very bad behaviors where now, even though you know your data, you're modifying that to try to chase after the dollar amount goals that you've set for yourself. So in order to prevent this, we need to look at trading in terms of risk factors and treat it like a strategy game, regardless of the amount of money. We need to reverse engineer our daily or monthly profit goals around our system-based results. Okay, so this is exactly what I mean. Say there's a goal of $200 a day. If you're trading, there's going to be break-even days, small win days, losing days, multiple back-to-back losing days. So if you're constantly focused on making that daily goal. And say the first day you break even, so now you're $200 behind schedule. Say the second day you lose $300. Now you're literally behind pace by $700, and it's going to lead you to try to say, well, if I just, let this trade run a little longer, or if I put a little bit more risk on the table about a trade that I really like, I can get back to schedule and chase after that. That's going to dig you further into the hole, and that's not how you want to look at it. So here's how we can actually design our strategy around that daily goal. I do that by reverse engineering with process-based goals. Okay, we know we're going to be trading 3 trades a day times 20 trading days is 60 total trades. We know that this is our daily goal, which is going to put this as our total goal over the entire unit of measurement, which is a month. So now all we really have to do is solve for R and figure out how much we need to be risking per trade following our process-based goals in order to get, by default, our desired result without ever focusing on money. So that's how we're going to do it. We have R, which is our per trade risk, equals our monthly goal within our process divided by the total amount of trades that we're going to take times our expectancy. So 60 trades times our 1.46 expectancy is going to give us that 87.6 total R. So we have our monthly amount divided by our 87.6, which is going to give us 68.4. So now we effectively solved for our per trade risk. So now, as long as we follow process-based goals with risking $68.4 on each trade, regardless of over what period or in what frequency any of this happens, the closer we adhere to this process, that is by default going to get us to our daily goal without ever focusing on what's happening on an individual day or ever thinking about money. And so once you have this foundational data, this is how you can figure out how to actually deploy into the real markets to hit your goals without ever actually thinking about money. Which brings me to truth number 10. There's a lot of different sources on the internet. What I try to do on my channel is base everything strongly around math, probabilities, and a practical approach to trading. It's very easy to slide down the rabbit hole of just falling into things that feel fun or exciting or sound overly complicated so it feels advanced and cool. Whereas the simple truth is the most effective style of trading is going to be one that is in harmony with what works for you and is based around data, what you can actually do. So finding a mentorship in a community that is also thinking exactly like this to be able to get to the desired result is going to be hypercritical, because who you surround yourself is going to dictate who you end up becoming and how you end up acting. Okay, and this is largely why I've built up this massive trading community. Everything that I'm talking about here, I teach in even more detail to a group of traders that are focused on their journey, looking at trading like math, and focused on keeping horse blinders on to reach success. So it's important who you surround yourself with, where you learn, and where you're executing these reps to hopefully get to where you're looking to go. The right environment and community can compress years of wasted time into a few months of learning. So at this point, your last step is basically to do this. Ask yourself 3 emotional drawdowns you have to your trading that involve greed, fear, impatience, or other. Figure out if you actually even know your expectancy, and if not, what do you need to do to be able to achieve that? And ask yourself, is your strategy refined enough to make it repeatable to even measure any of this in the first place? And if you tune this data in harmony with combating your natural emotional tendencies, you're going to find you're going to transform into a completely different person, look at life completely differently, and actually have a pathway to become consistently profitable and treat trading like a business, and ultimately get where you know you want to go. Okay, I hope this video helped. If you're still here and you enjoyed it, make sure you hit the like button. Why don't you let me know in the comments what that biggest struggle that you're dealing with is. You can check out the resources in the description. We have a Discord community, we have tools, I have other trading videos right here. But until next time, I will see you all in the next video.